So welcome everybody. I'm Mike Fiffick, the managing member here at Fiffick Law Group, the legal shield provider law firm here in Pittsburgh, Pennsylvania. And I welcome you to this webinar on startup and small business lending. We're very pleased to have Chris Trombetta here, who is the Senior Vice President of the Business Banking Unit at First National Bank, one of our local business partners here in Pittsburgh, Pennsylvania. And he's going to be talking to us about small business loans for startup and early stage businesses. So anybody that's involved in business, or if you're getting involved in business, access to capital is a really important part of your success plan. And I'm constantly telling my small business clients that having a good banking relationship is something that is very important for the success of your business. And the sooner you get started with that, the better it is. And the more that you can understand how banks look at small businesses, the better off you will be. And so I'm hoping that Chris will be able to share with you the types of loans that are available, the banking loans that are available to startups and early stage businesses, what they're looking for, and to help you position yourself to have success whenever it is that you are in a position to be applying for some funding. So with that, I'm going to hand it over to Chris. Just a couple of shirt pocket notes along the way. If you have questions, feel free to post them in the chat. I may feed those to Chris along the way if they're consistent with where he is in the webinar, but we will certainly get to them by the end of the webinar if we don't answer them on the way through. We're recording this webinar, and we will post it on our YouTube channel. Fiffick Law Group has a YouTube channel. If you've not visited it before, please do so. There are lots of webinars on there about small business and other legal related matters. So with that, I hand it over to Chris Trombetta. Thank you.
Oh, God. Thanks, Mike. Good afternoon, everyone. And thank you all for joining us today. As Mike said, my name is Chris Trombetta. I'm a Senior Vice President within the Business Banking Group of First National Bank. I've been in banking for almost 25 years, most of that time spent in the commercial world. I want to thank Mike and Fiffick Law Group for inviting me to participate, and to Logan Platt for all of his assistance along the way. And again, thank you all for attending. Now, I've been given the task of trying to make banking sound interesting. I'll certainly do my best. We'll again follow up on any Q&A that you might have. If you need me to clarify or expound on something, I will certainly do that. But I want to keep it very informal. I only have one rule, and I'm pretty strict about it, and that's, there are no dumb questions, trust me. Ask anything and everything you want. This is a major decision you're either making or have made, so do take advantage of it. So with that, we'll dive right in. I will apologize in advance, as I told Mike, as it just happened, the camera on my laptop recently has been acting up, and it looks like it's doing so now. So I apologize for that. So, I can talk for hours on this topic. I know that sounds pathetic, but I will try to keep it brief and succinct. So what do banks typically look at when you apply for a small business loan? I'm hoping in this presentation to pull back the curtain a bit and provide you with some valuable information. It's long been said since I've been in banking, and even before that there are typically 4 C's to credit. There's character, there's collateral, there's capacity, and there's credit. There is a 5th C, which is conditions. That's more applicable to the business banking world and the corporate lending world. Those involve things like regulatory issues, the economy, both domestic and globally, that could impact your business, the Fed, etc. But for small business owners, it's typically limited to the 4 C's. But the first C I'm going to cover is character. Unlike the other C's, this can't be measured or quantified. There are no spreadsheets. There are no data points when it comes to this. It allows us as lenders to consider your unique story. Why are you getting into this business? Why are you starting this company? What experiences do you have along the way? It gives us a lot of background about you as a person. It looks at your reputation as a past borrower. It looks at your past and current financial condition and your historical stability. Now, I will say this is not used on its own to make a credit decision. It's typically looked at, to be quite honest, last. And in many instances, after we consider the other C's to credit, if we can't make a decision, or maybe, we're on the fence, this C of character can typically push us in one direction or the other. And while it's not quantifiable, it is important. And I'll give you a great example. I have a client, a new client, who owns a gas station / convenience store / little mini restaurant. And he was in an agreement for a lease to own on the property from which he was operating. So he was renting, in essence, the property from the owner with an agreement down the road to buy it. And he wanted to pull the trigger on buying it. But when I got the numbers and, I went through the cash flows and through the credit and the structure and the agreement, I approached my credit officer, who has the approval authority, and he was somewhat on the fence. He said, the cash flow is a little tight. He doesn't have a lot of liquidity to him. I'm really on the fence. And that's when I said, well, I'll tell you what, let's go up and pay Rob a visit. We did that, and Rob sat down with us at his business. He talked about not only his past performance, but his vision for the business. He gave us a tour, and when we left, credit officers can be tough, but on the drive home, my credit officer said, you know what, we're going to do this loan. He was impressed with the passion that Rob had for his business. He was able to rattle off data, just asking him, what's your cost per gallon for fuel, and what's been the historical? How much did this cost? How much does that cost? What are your projections? And Rob really was beyond well prepared, and that provided a lot of comfort to Mike, my credit officer. So we actually ended up closing on that loan last year. As an update, Rob is performing extremely well, and coincidentally, he just told me last week about another potential opportunity. So, like I said, numbers typically bear it out, but character is also a key component in our considerations. The next slide talks a bit about collateral. Collateral are they're the assets a borrower pledges and that a lender can take possession of if that borrower defaults. And that's a horrible statement to make. I mean, it doesn't happen, all the time. But this, in essence, securitizes your loan. Whether it's a building, a vehicle or vehicles or equipment, you'd be required to pledge that as collateral for the loan. And what we do, and something you should be aware of, is that we apply LTV requirements. LTV is basically a loan to value. How much is that collateral worth in compared to your total loan? Or how much you want to borrow versus the value of that collateral. Limits are typically based on the type of collateral. Real estate will typically go 75 to 80% LTV. Vehicles will go 90 to 100% LTV. And with equipment, we'll typically do 100% on new, and that runs through about 50% of the value if it's used. So for instance, if you have a property that appraises for $100,000 We'll discount that 20%. We'll say we'll take 80% of the value, that's $80,000, and that's the maximum amount you can borrow, pledging that building as collateral. And then you can run those numbers through each of the different collateral types. For instance, equipment, new equipment, you're buying a piece of equipment for $15,000, would be able to lend 100% or $15,000 based on that equipment. The next capacity is capacity, and this is often the most important of the 4 C's. This refers to your ability to repay your loan or your debt to income. I will let you know up front that you will very often, if not all of the time, be required to either guarantee your small business loan or become a co-borrower. So that, in essence, quote unquote, puts you on the hook for the financial responsibility of that loan as well. Some folks come into the bank and it's happened to me many times, and they say, I want to apply for a $500,000 small business loan, and I will ask them for their financial information. Well, why do you need that information? I'm going to say, well, because you're going to need to be a guarantor on this loan or a co-borrower. There has been times where there's been pushback on that, but I'll be very honest with you. The typical response, and if you think about it, it is true. The typical response you'll hear from a banker is, if you don't want to guarantee it, well, if you don't have faith that your business is going to succeed, why should we? So, asking for a guarantee is normal course of business, folks, especially if it's a startup. We're going to rely on your support as well as you're relying on ours. The typical guidelines for consumer and individuals debt to income ratio is typically 43%. And that debt to income is basically what it says, your debt compared to your income. So you would take your gross monthly income and divide it by your gross monthly debts. And that's how you come up with that number.
Hey, Chris.
Yeah.
So for income, are you looking at the borrower's income, non-business related income, in addition to the business income?
It can be
calculate that.
Yeah, it can be non-business and business income.
Okay.
As long as it shows on your personal returns, that's what we will use.
Great. Okay. Yeah. Cool.
Now, for businesses, when we're going through the cash flows of your business, it's a little bit different. We typically, the typical guidelines for business is a 1.2 times debt service coverage. So what that means is for every dollar of business debt you owe, you have $1.20 in cash flow to cover it. That's typically an industry standard. And for instance, and maybe to help clarify, if your debt service coverage ratio was 1.0 times or 1-to-1, that means you're breaking even. So we're looking for that little bit of cushion and profitability to ensure that the debt is going to be repaid. The 4th C is credit. And this is simply determined by your payment history. There are 3 credit bureaus that are used typically: Equifax, TransUnion, and Experian. Your credit score can range from 300, which is the poorest rating, to 900, which is the best. And I'll be honest with you, I've never met anybody that has a 900 rating. It's calculated on how an individual repays your debts relative to everybody else out in the market. They collect that data from basically the population that uses credit, and they compare your history with that gross combined history. Now, I will give you some tips because credit is, I can't stress to you enough how important credit is. One tip, credit cards. You know, if you max out that credit card or credit cards, that's going to be considered into your payment history. If you close unused credit cards, or you simply don't use them, and a lot of times, you know, over the past several years, with all of the promotions that come out, you know, we all get them. You get a Capital One promo, no interest for, you know, 6 months. So a lot of folks will transfer existing credit card balances from one credit card to another one. And they get that next promo a year from now. They move that balance from that credit card over to the next one. If you take nothing away from this, just do me one favor. When you move those balances to a new credit card, make sure you close out that account with the creditor. And I truly can't express that enough, because if you don't, what we do in underwriting is we max out your availability on all of your credit cards. Even if you have a $10,000 credit card and you have $1,000 on it, we will, in figuring out our debt to income ratio, we will max out that credit card at $10,000. Why do we do that? Because once we close the loan, you can take that credit card on which you have $1,000 and you can charge it up to $10,000. So if you think about it, if over the past 2 years, you've had maybe 5 credit cards with a $10,000 balance each, that's $50,000 in debt that you may not owe, that will be factored into your debt to income ratio. So please take that tip to heart. Disputes, you know, oftentimes there are disputes with creditors. Make sure you get, you know, those issues resolved. You can even maybe talk to Mike about it, and you know, make sure that gets removed from your credit. Another tip, co-signing. You know, oftentimes we you know, in most instances, you know, we want to help our kids or a family member, and you know, they're buying their first vehicle and we will co-sign for them. Well, co-signing means just that. You are co-borrowing those funds with another individual. So that debt will also show up on your credit. And as you know, hopefully not through experiencing it, but if that person defaults, the bank is coming to you for payment. So, you know, be somewhat judicious in co-signing for individuals. I will tell you that business loans, typically, you know, if it's in the name of the business with you as a guarantor, those typically do not show up on your personal credit reports. So just food for thought, so you have that.
I think this is a good thing to be talking about. You can modify or improve your credit score in the month or two ahead of applying. So it is definitely something that savvy people who are applying for loans understand about the loan process, and they will make some changes in their credit usage, right? Before they apply for the loan. So this is, I think, I'm really glad, Chris, that you covered this, because it's something that, you know, people probably have a general understanding that your credit score has an impact, but they're not quite sure how they got that credit score or what's involved in getting that credit score, or that they can change it to the better. And that's part of a process they should be considering whenever they're thinking about applying for a loan.
Yep. Exactly, Mike. And to show you how important it is, we're going to spend a couple more minutes on it.
That's great.
You know, the next slide I have Other factors, people think credit scores is just plucked out of the air and, why do I have a 550 instead of an 800? Well, here are some of the factors, all of the factors that do affect your credit score. The most weight is given to your payment history, period. If you are, delinquent on any loans, that's going to drag down your credit score. I will say that, not that there's good delinquency and bad delinquency, but everyone at some time may have experienced, that blood test you got, and you were never billed at $25 and now it's showing up on your credit. That's easily explainable. That's something that the banks will, not overlook, but sort of understand. But when you start talking about any type of mortgage delinquency, automobile delinquencies, that's going to make it more challenging for you to obtain financing. One big strike is student loan debt, especially backed by the government, Fannie or Freddie. That's looked at rather harshly. So 35% of that weight is given to payment history. 30% is the amount you owe. They don't, the credit reporting agencies, and this is one of my only beefs with them, they don't know how much someone makes. If they have total credit out there of $300,000 or $400,000, $2 million a year. I mean, it's all relative. But more importantly, with amounts you owe is how far to the maximum are you? Meaning, like we talked about a bit earlier with credit cards. If you have a $15,000 credit card and your balance is at $14,500, that can adversely affect your credit score.
This is one of those little things that you can do, if I mind my commenting, that you can use to manipulate your score. You could ask some of your credit card companies to increase your credit amount. However, you want them to do that without a what is it, Chris? I can't remember you want to do it without a credit check. There's something that you have to do, right?
Yes, they can certainly do that. Now, it's a double-edged sword. You've got to watch how much of that outstanding that you do have. If you do increase it from say 15 to 25,000, we're now factoring in that 25,000 when we're calculating your debt to income ratio. Mm-hmm. So while that's certainly an option, just tread cautiously with it. One other factor is length of credit history. That's sort of self-explanatory. And then a couple other items of type of credit and new credit open. Recently opened credit accounts such as an automobile purchase or credit card, can have a slight effect on your credit, but I've not seen that be anything that's too concerning. So okay, I think I've spent enough time hammering you folks on credit and how important it is. We'll move along now and change gears a bit to the most common types of loans. The most common types of loans when it comes to small businesses are your real estate loans, your lines of credit, and equipment/term loans. With regards to real estate, the commercial world is different than the consumer world. In commercial real estate, banks typically offer terms up to 15 to 20 years at a maximum. There may also possibly be a balloon. There are no, at least I don't know of any, there are no banks doing 30-year commercial loans. Again, it's not consumer related. So banks typically tighten up that term and amortization period. And when I say a balloon, you may get a loan that's amortized where the payment's calculated based on 20 years, but the term will end in 5 or 7. And then once that 5th or 7th year is done, then that larger balloon balance is due at the end. Now, Typically that's done, on newer businesses. It's sort of let's see how this goes. Let's see how your business is performing. We'll revisit it in 5 to 7 years, and then we can turn it out into a more traditional term. The rate on commercial real estate will be adjustable or fixed. I'll be totally honest with you. When it comes to commercial real estate, there's a unless you're doing maybe a 10-year term fully, it's going to be an adjustable loan. And what that means is, the most common is a 5-year adjustable. So we'll give you an interest rate. It'll be locked in for the first 5 years of your loan. And then once that 6th year hits, that rate will adjust to a predetermined, that you agreed upon, a predetermined spread and cost of funds to give you that new rate for an additional 5 years. So if you think about it, you're going to have a rate for the first 5 years. You're going to have a rate for the next 5 years, for the next 5 years after that, and then for the last 5 years of your loan. Commercial banks do that typically to offset any type of interest rate risk on their end, and it's just common practice throughout the industry. Sometimes, there's a 3-year rate, and or even a 1-year rate. Some clients actually prefer that because they feel that rates are going to drop, 5 years from now. So, it's sort of a cat and mouse game, but that's typically how that's set up. Now, with regards to real estate, what you'll typically need are the following: an appraisal of the property, proof of the property insurance with the bank listed as lost payee, title insurance if it is a purchase, and then the bank will file a mortgage and typically an assignment of rents. An assignment of rents is a legal document, and think a mini strip mall that has 4 units or 4 stores. We'll file a mortgage on that property, and then the assignment of rents is a document the borrower signs saying that if they default on that loan, the bank can step in and those rents are then assigned to the bank, meaning your tenants would then pay the bank. And then we would use those funds to make the loan payment on your loan. And any additional would be either an escrow or sent to you. So again, a mortgage and assignment of rents is typically filed. And then lastly, an environmental report of some sort. Not in every case, if it's an apartment unit, or a single tenant building, we typically don't need an environmental report. And there are several kinds. There's an environmental checklist, which is the least amount of due diligence on an environmental, and then you go to a phase 1 where you actually engage an environmental company to take soil samples and whatnot. Then you have a phase 2, and if there's any contamination, the borrower or buyer or seller is responsible for that remediation. Now, this typically happens in industries that are maybe, like gas stations, quick oil lube stores. If it's a manufacturing company with equipment, that uses oil and fuels, things of that nature. But if it's a flower shop or an apartment building, an environmental report is typically not required.
Chris, I was just going to comment, and I'll ask your opinion as well. The length of time it takes to close on a loan that involves real estate as collateral, I'm, at least from my estimation, you're probably looking at least 2 months from application to closing to get the appraisal done and all the other things that are necessary. Would you say that's about a fair estimate?
I would say that's the exact estimate I was going to give, 60 days. And keep in mind, You know, the appraisal typically takes the most time.
Yeah.
That can go anywhere from 3 weeks to 5 weeks. And I won't even get into the minutiae of how long it takes for an environmental. But 60 days is a good way to give you an idea on how long it takes. Now, I will say that the banks can only move as quickly as you as well. So the sooner you can get us all of the financial information we need, the lease agreement, the contracts, whatever's required, if you can move rather expeditiously on that, that will only help the process.
Yeah, and I would also just say to anybody out there that's buying real estate, it's very important to do due diligence before you buy the property, because I've had deals get hung up where a property is now, it hasn't been used as a gas station for 30 years, but it was at one time. And you're going to end up needing an environmental report for that. And sometimes finding the information on an old use like that can be very difficult to do. So definitely do your homework if you're buying property to make sure that you have a good understanding of what you're getting yourself into, because, and you have to be thinking like a lender, and you're going to need these things in order to borrow on the property. These are things that if you haven't done it before, you're not really thinking of, but good counsel can help you anticipate these things.
Absolutely. And I'll even take it a step further. I've been asked several times to do an environmental checklist because the property that's being acquired sits next to a gas station or a car wash. So environmental concerns are a big deal. One final note on the real estate, as you can see, it can be a costly venture, with the appraisal, with the filing fees, title insurance. You're also going to have that down payment requirement of anywhere between 20 to 25% as well. So keep that in mind as well. The next type we're going to discuss is lines of credit. They're typically called working capital lines of credit. This is simply a revolving credit facility used for working capital purposes. It helps to cover things such as accounts receivable, inventory. I will stress it is not for hard asset purchases. I apologize. My apologies.
You can't buy a business partner that's tough.
Yeah. Sorry about that. It's not for hard asset purchase because we run into useful life issues. You don't use a line of credit to buy that printing press for various reasons. One, it's a collateral mismatch to the purpose of a revolving line, and plus lines of credit are typically interest only, so there's no principal reduction, and that can oftentimes jam you up. For a line of credit, you want to use, you want to pay it down, you want to use, you want to pay it down. Think of a credit card. You want to draw $2,000. Well, your monthly payment that you're going to get a bill for is going to be interest only. So it might be $84. You definitely want to pay down some of the principal. That truly is the key. Don't make the minimum payment. And when I say to cover accounts receivable and inventory, let's say you draw down $10,000 to purchase inventory. Then you sell that inventory for, say, $15,000. Well, once you get that $15,000, perfectly, you'd like to pay down the line that $10,000 with that $5,000 net going to you. So that helps revolve that credit facility. Same with accounts receivable. You spend X amount of dollars doing a job for someone, you're not going to get paid for 30 days. So you draw the line of credit to cover those costs. And then once that receivable comes in, you take a portion of that, pay down your line, and the rest goes to the business.
Chris, Michael Bailey asked, can a line of credit be used to pay for advertising expenses?
I'll be very honest with you. A line of credit can be used for any purpose you wish,
right?
As long as it's business related. It's just wise to think about how you utilize that. You don't want your line of credit creeping up until you're at the maximum and don't have that resource anymore. But with regards to advertising, if it's not too substantial, I would think that wouldn't be an issue. But again, you're looking to pay down that line with funds from your customers. So, if you can quantify that the advertising brought in X amount of revenue, then, I don't foresee that being an issue.
Yeah, I see this as something for non-recurring, or maybe something that's non-recurring, but maybe you have a large expense 1 or 2 times a year that you use this to cover it, and then you just pay it down before it occurs again. Maybe you have an insurance bill that comes in and you get a discount if you pay it all up front. Maybe you do it with a line of credit and then just pay the line of credit off, after a while. Those types of things.
Yeah, and
lots of reasons for it.
Yeah, and one other scenario, and this is even agreed upon, with your banker, and I'm not trying to get in again to too much minutia here, but with a CapEx line, it's a line of credit. Let's say you do buy a piece of equipment. Your banker knows, hey, Chris, I'm using my line. I'm going to buy this piece of equipment for $10,000 because I can get it cheaper, and quicker if I just pay for all of it. And then once I purchase it, can you do a term loan to pay it off and make it a traditional term loan? We do that quite a bit, actually. So you'll buy the equipment, you'll use your line. I'll come in, I'll give you a term loan for that equipment for 5 to 7 years. We'll pay down the line, what you paid for the equipment. Now you have that term loan on the equipment, which is a match from a collateral perspective. And then you have the availability from your line as well.
Right. At a lower interest rate too, probably lower cost, right?
Right. And yes. And, there are 2 things some banks do require when it comes to line of credit. And that's a clearance requirement, and that's a dormancy requirement, meaning they will have in the loan documents that you're required to pay that line down to 0 at least once a year. Smaller businesses, that's typically not in there, but I have seen it from time to time. And the dormancy requirement means not only do you have to pay it down to 0, but you don't touch it for 30 days. They want to just see that the company is able to, handle itself over that 30-day period without reliance on a line of credit. And then finally, with regards to the lines, is the rate. The rate on lines of credit is typically floating versus a fixed rate. So it'll be either prime based, prime plus a spread. Prime right now, I believe, is at 3.25%. And then, or it can be a LIBOR rate, et cetera. But, all that means is, prime changes on a monthly basis, or it can change. Well, prime actually changes when the Fed changes the prime rate. So that rate can go up or down. It just follows the ebb and flow of the Fed. The last type, equipment/term loans. And we've sort of talked about this in between some of the other slides. These are loans to purchase fixed assets such as equipment, vehicles, etc. The terms typically match up with the useful life of the equipment. If you say, hey, Chris, I need a new pickup truck for my landscaping business, you buy it for $20,000. I'm not going to give you a 20-year loan on it. We'll typically go 5 to 7 years on those types of loans. And then typically it's a fixed interest rate with fixed monthly payments. Mike, something you were referencing, it is indeed a fixed rate that you'll have throughout the life of the loan. Folks, that's really the information I had for you today. I can't recall how much time we had today, but just a couple closing remarks for all of you. First of all, and one I didn't even put on there, is I admire the heck out of all of you. Anyone who currently owns their own business or is thinking of doing it, I give you folks a ton of credit. And you're already ahead of the game. I mean, listening to webinars like this, which I'm hopeful was somewhat helpful, partnering up with firms like, FIFIC to help guide you through the process, and someone who can be your partner. Doing your due diligence, you're already ahead of the game than most people. And I will say, and Mike, I believe you mentioned this in the introduction, your business banker should be your partner and your trusted advisor. You folks are basically a team. And, I have that relationship with the clients in my portfolio. FNB is big on relationship banking. If someone comes to us and wants a $2 million loan, there's been many times I've passed on the opportunity because they want it to be a transactional business. We're all about relationship banking and being an advisor to you. And then the last bullet is, keeping open communication with your banker. Another point I can't stress enough, not only so they know and understand your business to help you, but sometimes more importantly, to help you along if you hit a bump in the road. And if anything's taught us that, it's 2020 and this past year, with so many companies hitting a bump in the road. Keep that line of communication open. Keep your banker informed. If they reach out to you, I know it's easy and frustrating, and it's easy to say, to not duck it, but to sort of, we tend to bury our head in the sand, hoping it'll go away. It won't. Keep the communication open. Bankers, contrary to popular belief, are not the bad guys we're sometimes portrayed. We love nothing more than helping folks like you to succeed. So.
Yeah, I totally agree. That's been my experience as well. And I do encourage my clients to find a bank that is a good fit for them, especially from a size standpoint and a I don't want to say a social standpoint, but a relationship standpoint, right? You have to have a bank that's looking for your type of business, or for you as a profile customer. There are bad fits, out there. I would just say, and so you got to find a good fit. My experience with FNB has been they're very good from a small business perspective. They are good relationships. They're very accessible. Hopefully, if you've caught any of our webinars from our friends at FNB, they're nice people, and they've got a lot of good information. And what I like is that they're willing to help you, and they to position yourself in order to succeed, which is a really good thing.
Well,
hey, Chris, I have a couple questions for you here.
Absolutely.
So Michael asks, comparison between brick and mortar versus an online business. Is it easier to get a small business loan for a brick and mortar business versus an online or a web-based type business?
No, I don't really think it's any easier or any harder. The one hurdle that will often come up is collateralization. If you're an online business, your business assets are cables, computers, desks, chairs, versus a building and or equipment. But again, if the projections and cash flows there, it shouldn't be a hindrance. You should expect, unfortunately, you may need to pledge some personal assets in order to obtain that first loan. But that can always be worked out where, if you have to pledge your home or an investment account, that, X many years down the road, maybe even two, they can release those and shift to all of your business assets.
Chris, I would imagine with some small businesses, you run into some situations where businesses don't necessarily have their books put together in a way that would be ideal, right? There are probably some small business folks who they're worried more about building their business and marketing and all those types of things. And sometimes maybe the bookkeeping or record keeping suffers a little as a result. Do you see that out there?
We do. And in addition to your attorney, your banker, it's also pertinent to get a good accountant as well. Now, I will tell you that there are a lot of things out there, resources for small business owners and those who want to delve into that. The University of Pittsburgh, St. Vincent College, they have small business hubs that will offer seminars. They will assist you with making projections, things of that nature, a business plan, and oftentimes at little to no cost. So, be sure to look into those as well.
Yeah, I think it's one of those sort of soft things that business owners, folks that are going into business or new into business maybe don't understand, that they really have to have their books together, their ducks in a row. That makes a big difference, I would imagine, from your perspective, Chris, if you're presented with somebody who wants a loan, who has their stuff together, that you can understand their story rather than having to try to figure the story out
Absolutely.
with a lot of hard work.
Absolutely. Without a doubt.
So another question here, and this I think applies to the loan application process. Are you looking at the individual social security number or the business EIN number, the employer identification number, or are you looking at both?
Typically, we're looking at both. The social security number to pull their individual credit. There are services out there that we utilize with regards to EIN numbers that show any business bankruptcies, things of that nature. But no, we typically look at both.
Okay. Will you allow a borrower to pledge as collateral a cash account or an investment account or something like that?
Oh, absolutely. With one caveat, we are, and this is a regulatory issue, you are not able to pledge IRA designated funds as collateral for your loan. So if you have a brokerage account, full of mutual funds, money markets, yes, those can be pledged, but if they are IRA designated, they cannot. And cash, absolutely. And there are, I've had many clients who securitize it with cash till they're up and running, till they start gaining the assets, and then we release our hold on those funds and substitute the collateral. So
I guess I should ask, in this day and age, will you use Bitcoin for collateral?
You know what? I have absolutely no idea.
That's something we probably all have to catch up to, right?
Yeah. I can't see my credit officer signing off on that one. Yet anyways.
Let's see. We have another question here. I'm not sure you'll know this one, but I'm going to pitch it to you anyway. How long does it take to increase your credit score with a new auto purchase? Maybe that question is really, how long does it take to increase your credit score if you try?
There's no secret sauce or secret formula that tells us that.
Yeah.
I do know that, credit scores are typically updated real time, or at least, within, several days of either a purchase or a closure of an account or a paying off of an account. I've had folks tell me, hey, I know you're going to pull my credit, but wait until X date because this will be paid off. So I don't think there's a real formula for how long it would take.
Yeah, my experience is that it can update relatively quickly, but it's not just a day or two. You may, if you're thinking about applying for a loan, you may want to do your stuff and apply a month or two later. That would be my suggestion.
Yes.
What is your credit score if you never borrow money? Well, that's an interesting one. My guess is I might not be able to get one. I don't know.
You don't have a credit score.
Right.
Now, and that's actually, I know I've been preaching a lot, but, with my daughter, I did co-sign on her automobile loan.
Totally. I was just thinking that, Chris. This is on my to-do list. My middle daughter, who's a sophomore in college, I need to get her a credit card so she can start establishing your credit score.
Yeah.
Credit score. I did it for my older daughter, and then I sort of handed her off.
Yeah.
So I got to do that for her too, right?
And I will brag that she's done magnificently with it. She's also in the unfortunate position of both me and my wife both being bankers, so she gets hammered over the head quite a bit about it. But yeah, if you don't have a credit score, I even had her open up a Capital One card. They wanted to give her $2,000. We called. We said $500 just to start establishing that credit.
Yeah.
But if you never borrowed money, then no, you do not have a credit score. How do banks look at that? Might be the follow-up question. That's tough to say. I've not personally experienced having a client with no credit score. I guess it means that I would have to say it's a positive that you don't, carry an insurmountable amount of debt, but there's also no history for us to go back on.
Right. That would be you don't want to present unusual for whenever you're applying for loans. That's I always tell my clients. You don't want to be the oddball. This is lenders, and in other situations, people have a difficult time trying to figure out what the oddball is. And sometimes they just say, I don't want to deal with odd.
Yeah.
Let's just
Yeah.
avoid it. Right.
And you know what? And since I brought up Capital One, I will throw this out there as another tip. You know, when you do apply, when you do get a new credit card and you get the promotion, every time I've received a credit card, which I only have two, you know, they'll send it to me and say, you've got a $50,000 limit. I always call and I say, no, bring it down to 10,000 or, you know, whatever I feel is necessary. I don't want that $50,000 limit out there for reasons we discussed earlier in the presentation. So.
Right. So I think that's all the questions that we have, at least in the chat anyway. So with that, I'll just say thank you, Chris, and thanks everybody for attending the webinar today. We greatly appreciate it. Again, we'll post this on our YouTube channel if you didn't catch all of it or you'd like to see it. Chris, is there any contact information that you'd like to share with anybody?
Absolutely. I'm located in Monroeville at the corner of 22 and 48, right off the end of the turnpike. My phone number is 412-373-4844.
Great. I'm sure Chris will be happy to take your call, even if you have an offline question that you want to ask. He takes referrals if you're not calling just for yourself. So it's great to be a resource for your customers, right?
Absolutely.
And to connect them with somebody who can really help them out. So.
Yep. Well, spot on.
Okay. Well, thanks everybody. I greatly appreciate you attending today, and be looking for our webinars coming up in the future. So thank you very much. They're all posted on Eventbrite.
Thank you, everyone.
Bye-bye.
Bye.